Welcome to the Better Podcast, where you and I get better in this game called life. I'm Chin, your co-host today, and I co-founded The Smart Investor, an investment site where we talk about stocks all day.
And I'm your co-host Ser Jing. I run the Good Investors investment blog and a global equities investment fund together with my friend Jeremy Chia. Now, before we start, here's a disclaimer. Nothing on this show should be taken as investment advice. It is purely for informational and entertainment purposes only. All opinions expressed in this show by us and our guests are solely our own opinions. We and our guests may hold positions in the financial assets discussed in the show, and these holdings are subject to change at any time.
Welcome back, everyone. It's the morning of the 13th May. We're recording here together with Ser Jing and myself. And I wanted to start with something which I think will be in everyone's mind, and that is the stock market and how it's performing today, right? So to give you some context, according to what I measure, the Nasdaq is down close to 30% from its 52-week high, and I'm referring to the intraday high here. So it's pretty much a bear market, or much worse than a bear market for a lot of people, right? And if you look at behind the hood, if you sort of lift the hood and look underneath, I think the damage is even worse. There are some statistics which said close to half of all stocks within the Nasdaq are down by 50%. So pretty brutal market out there, right? And for the S&P itself, it's down roughly about 18%, but it came close to becoming a bear market, I think, this week. So as I look at the entire stock market today, it reminded me a little bit about the great financial crisis which I went through and how terrifying it was, because that was probably in my third to fifth year of investing. So a lot of foundation of investing were not set yet, but it also taught me a lot of good lessons on that I could survive a crisis and actually come out stronger. So I wanted to share three things with you guys, which I think will be helpful to put some context into all these declines. And two of them actually comes from Warren Buffett, because during the financial crisis itself, he actually wrote an article called Buy American I Am. And this article was special because if you know Warren Buffett, he never announces his buys before he actually does it, right? He's not a person who will tell you he's buying this before he actually does it. And part of it is, I think, for practical reasons. At the scale of Berkshire Hathaway itself, he cannot announce that he's going to buy shares of Apple, because then everyone will flood into the shares of Apple and make it not cheap anymore. And that article is about him investing his personal wealth. So this is nothing to do with Berkshire Hathaway. It's Warren Buffett's own money, cash that he's putting into work. So the first thing I want to say is that he wrote that article on 6th of October 2008, right? By then, the great financial crisis had already lasted for about a year. So that decline was about 40%, and it had already lasted for about a year. So if you compare it to what we are experiencing today, the decline has happened for roughly about 6 months. So this is like 2 times longer and 10% worse compared to what the Nasdaq is suffering today. So when I say 40%, I'm referring to the Nasdaq. And that's when he wrote that article. Now, the interesting part is that he did say that he did not know how the stock market is going to perform the next month, the next year, or even 3 years from now. But he was starting to buy, right? And that, I think, is a really important note, because even though he said buy, he wasn't calling the bottom. And indeed, the decline actually extended for another 6 months. And the Nasdaq fell by another 26% before it bottomed out on the March 2009, right? So here we have one of the greatest investors of our generation who has been doing it and producing results for over 50 years, not being able to time the market, right? And that's okay, right? Because investing, I think, is not about catching the perfect bottom or buying the lowest ever price, or buying a stock and not having it drop after that. And for the case of Buffett, he already knew that and he accepted that and he said so himself, right? And when you look at 16th of October 2008 to where the Nasdaq is today, and remember the Nasdaq just fell by 30%, right? It's still a gain of 500 and over 560%. So over a fivefold gain since that date which he wrote that article. So even though he missed that bottom, he actually did quite okay with all his stock buys, right? I would imagine. So I think that this is a really important point. If you're investing out there, if you're thinking about waiting for the market to bottom out and so on, please don't. Please try to invest in stages, invest in a pace which is comfortable for you, because that's really important. You want to maintain a rational mind when you actually invest in a bear market, because once you lose that rationality, you're going to make really bad decisions. So that always has to be your highest purpose, right? The second point, which I wanted to put out, was that he also made one single point, which I think is really important and put more context into why I feel that everyone should continue investing in a sort of monthly basis. He said that the good news, or rather the stock market, will likely uh, sort of make a U-turn and go up before the good news appears, right? And I think this is really relevant for what we have today, because if you look at all the news today, it's almost uniformly bad, right? There's inflation, there's food costs. I mean, if you go to your local hawker center, I think that you'll feel it too, right? Some of the hawkers are forced to increase their prices, right? And they're increasing it because food ingredients are becoming more expensive. Logistics is becoming more expensive. You have supply chain issues. You have China shutting down for COVID. You have all these different issues. You have the Fed increasing interest rates. And when I look through the news today, there's almost nothing good to be said, right? And I think we're in an environment where it's much more easier to become a pessimist than to become an optimist, which I feel that it's an ingredient where there's a lot of uncertainty, and this is why you have low stock prices. If everything was clear, then you will not have all these low stock prices. And I think that's really important for everyone to understand that that the upturn happened for the great financial crisis on March 2009, but the US actually exited the recession, or because you measure recession by GDP contraction, right? So the US actually exited recession in September 2009. So that's 6 months after the stock market actually started rising. So this goes to show that you can't really time the market, and the upturn will happen before the good news appears. And if you look at what Buffett is doing today, right, he actually invested more than a third of his cash, and this is a big move for him, in the first quarter itself. And you can tell that he probably has so-called mistimed the market again, because in April, worst market decline ever. In May, we're seeing further declines. But do you think that Buffett is worried? I would doubt so, right? I don't think so. I think that his horizon is much more long term, and you do need to measure all this, your stock performance in 3 to 5 years time periods. In fact, I sometimes feel that 3 year periods are a bit short. I think that 5 year periods are much better. So don't lose hope. Keep on going. I will just pass it on to Ser Jing if he has anything else to add to.
Yeah, sure. So thanks so much for sharing all these thoughts about Buffett, his recent actions, as well as actions during the great financial crisis. There is something really interesting about Buffett's experience investing over the decades that I also want to share. I think it can help inspire investors out there who are perhaps feeling the pain of what's going on in the markets today. So a few years ago, I learned that Buffett had invested in this company called the Washington Post Company. back then in the 1970s. So back then, the company was a renowned newspaper publisher in the US. Today, I think the name has changed to Graham Holdings Company. But what's important here is that from his investment in the early 1970s to 2007, Washington Post was a 100-bagger. So when I first learned about that, I thought, wow, that's a great return. And what was also interesting was that Washington Post's share price actually declined by 20% or more right after he had purchased those shares. But I only recently found out that the decline was likely a lot worse than 20%. So there's this investor in the US called Marcelo Lima. In a recent tweet, he shared information where he deduced that Buffett's purchases of Washington Post in the early 1970s had probably declined by more than 60% in price from top to bottom, right? But even despite that 60% decline, the overall return that Buffett had earned from Washington Post by 2007 was like a 100-bagger, right? He had earned 100 times his money in Washington Post, despite a 60% decline that happened just a few short years after he had invested in the company. So I thought that was kind of a really interesting kind of a data point about how investors can still make tremendous returns over the long run, despite encountering very sharp share price declines in the initial days of the investment. But of course, I think the caveat here is that you need to be invested in the right companies. And Washington Post back then had a really strong competitive position because of the newspaper that it was publishing, and it attracted a lot of advertising dollars. And I guess another really interesting kind of I'm kind of like shifting topic just a little bit. Is that what was also interesting about Buffett's investment in Washington Post was that when he had made the investment, it was I think sometime during the 1973 and 1974 bear market in the US. It was a pretty rough time to be an investor in stocks in the US at that point in time. And I think he wrote something along the lines of being able to purchase Washington Post at a total market value of about 100 or 200 million US dollars when its actual intrinsic value was a few times higher. So maybe like 400 or 500 million dollars. And he said that it was not a secret, like he did not have to use any fancy math or fancy data to come to that conclusion. Everything was out in the open. Any reasonably intelligent business analyst or industry insider would be able to deduce that Washington Post's value was a few times higher at that point in time than what the share price was indicating. So I think that also points to the importance of having just the right attitude and as well as framework for thinking about investing. So at that point in time, because it was during the throes of the bear market when Buffett made the investment in Washington Post, it was a tough time to actually make the purchase, right? It would have gone against most people's basic psychological instincts. You want to escape from the pain that you've already been seeing in stocks, and so it's not easy to buy. But in his mind, Buffett was saying that, wow, this is like a no-brainer bargain, right? I'm seeing that the value of this company is so much higher than the share price, and I think that this is a great business, so I should be buying. And he did. So I think that was a lesson that he shared in one of his older shareholder letters. So I can't remember the year now, but I can probably add it in the show notes later. So that letter I think was something that I read a few years ago, and whatever was written about Washington Post has always stuck with me.
Wow. So I think the other thing which came to mind was this story or sort of analogy which David Gardner just sort of shared. And I'm going to change it a little bit because he was talking about basketball, so I'm going to change it to football, right? Which may be something which Singaporeans will maybe connect better with. So in a way, it's almost like you're a professional footballer and you just miss 10 penalty kicks in a row, right? I think that feeling is really, really bad, right? So it's almost like every stock you buy just keeps on falling, right? And if you look at the statistics, if 50% of Nasdaq stocks are down by 50%, then you have almost a coin flip chance of actually picking a stock and seeing the value being cut in half, right? So those are the odds today. It does not mean that, and I know that there are really unhelpful pessimists out there who will tell you that, if your stock gets cut by half, you need to make 100% to make a gain. The math is correct, but I think they totally missed the point, right? So it makes you sound smart because the math is correct, it's unrefutable. But I think the context is that a lot of stocks can actually recover really fast. And I saw that during the great financial crisis, right? You have stocks doubling or tripling in very, very short time frames. So I think that I wish I had statistics to show how many stocks actually doubled or tripled within a month of making that down during March 2009. But I have not been able to find statistics so far because I think that probably that period news was so bad, no one was actually doing that calculation, right? So, which brings me to my third point, right? And this really comes from one of my favorite investors, Tom Angle. He made the statement a bit unjust, I think. So there's this sort of advice or conventional wisdom that you should never fall in love with your stocks, right? And Tom said that if you believe that to be true, then you should consider the opposite. Don't fall into hate with your stocks, right? Try to look for the positive. And I think that this is really important because I think historically investing has always been about trying to figure out the downside. You're creating that margin of safety. Was it chapter 8 or chapter 20? I can't remember. I'm sorry for that. But it's one of the chapters 8 or 20 on Ben Graham's The Intelligent Investor. But what I prefer from Tom Angle's method is, yes, you can consider the downside, but think about the upside as well, right? Look for the positive news within all the bad news, because right now the news is so uniformly bad that I think that it's unusual or even audacious to actually be an optimist. And if you look at the current results for some of the companies, and we talked a little bit about this last week, you look at Amazon, Alphabet, and Microsoft, the cloud revenue, so AWS and Google Cloud revenue, and Azure for Microsoft, all this revenue are actually increasing by 36% for AWS, 44% for Google Cloud, and 46% for Azure. And these are, mind you, these are not small businesses, right? These are
huge.
This is not like $100 million business. This is not like a $1 billion business, right? This is like for AWS, if you take the latest quarter's revenue and analyze it, meaning you multiply it by 4, you're talking about a business which is generating like 74 billion in annualized revenue. And in the case of Microsoft, if you take its entire cloud business, which includes Azure, because they don't break out Azure, it's worth north of $93 billion annualized, right? That is crazy to be growing at this sort of rate when your revenue is that big, right? Reaching that level of revenue is already a huge feat, but being able to grow at that level with this sort of scale of revenue, I think is quite amazing. Other areas I'm seeing is, for example, payments. If you look at Block, which used to be called Square, its gross profit, which is a better measure, I think, of its progress, rose by 34% year on year. Mercado Libre's fintech services saw its total payment volume increase by 72% year on year. So there are positive news out there. It's just being buried by all this negative news. So I think that as an investor, you're not an economist, you're an investor. So do seek out all this information and find all these trends because they're out there.
I think it's this point about looking for company data is super important, because I think there's also this really interesting behavioral quirk that I've noticed in investors, myself included, right? In that share prices can drive narratives of the business fundamentals. And what do I mean by this? So, for example, you mentioned Block, you mentioned Mercado Libre, right? By any measure, the growth rates that they have produced, that you have talked about, are fantastic. But if the share price declines, and if it declines hard, it's easy to come to a conclusion that the business is just in shambles or the business isn't doing well. But when you look underneath the hood, another picture emerges, which is that of a really healthy, thriving business. So there are times where stock prices and business fundamentals disconnect widely, right? And in those situations, I think it's really important to kind of safeguard ourselves psychologically in that, we need to be aware that share prices can drive narratives about the fundamentals of a business, and we shouldn't let that affect our analysis of a business. We should be always looking at the actual data of the companies and not try to let the movement of the share price influence our thoughts on whether or not this company is doing well or doing badly. I think that is super important, especially in this current climate where share prices have fallen hard. Like, it's really easy to just look at the share price chart and think, oh my god, this business must be in severe trouble. But when you look underneath the hood, it's a somewhat different picture may emerge.
Yeah. So I guess it's almost like if you want to look for bad news, you're gonna find it, right? Because
Absolutely.
yeah. So I think in this environment where bad news is like almost the norm, you actually have to go against the grain and look for the good news, right? Because it's out there. There are companies which are still growing. They may not be growing as fast as the pandemic and so on, but don't assume that whatever happens in this quarter is going to go on for perpetuity, right? For example, Alphabet actually grew at, I think, 13% per year in 2016 or 2014. So it grew only
Amazon as well.
Yeah,
I think Amazon
the
grew
revenue
below
just slowed, right? And everyone assumed
Yep.
that your market is saturated and so on. And look at where they are today. They are posting much faster growth rates today because there's YouTube, there's Google Cloud, and so on. So
Yep.
don't take what you see today to be something that's going to happen to perpetuity. I think that's also really important. And speaking of important, I heard that you had a very important prata lunch yesterday and learned something new.
That was super interesting. So I was having lunch with a bunch of friends that you and I both know. And one of them would be Thomas Chua. So Thomas writes this really good investment blog called steadycompounding.com. And which I will share in the show notes as well. And he was in, I think people who are listening to this, you can also find Thomas on Twitter. I think his Twitter handle is @steadycompounding, which I will also share in the show notes later. But so what Thomas shared, so this is nothing to do with investing on the surface, but it kind of kickstarted some interesting thoughts in my mind when I first heard about it. So Thomas is interesting in that. So in when he was in university, he actually took up a module studying human evolution. So he actually studied like Charles Darwin's work and so on.
Okay.
Yeah, on human evolution. And one of the things he learned was that, so as humans, we are one of the very rare animals who are able to move about on 2 feet, and that is our default mode of movement. If you think about it, most animals actually move on all fours, right? Very seldom do you see animals that are actually moving on just 2 legs. And the reason why is because our hips have changed to allow us to be able to walk on 2 legs upright. But our back is actually the bone structure in our back is actually not evolved to the extent where it's perfectly suited for upright walking. So there's actually still some evolutionary defects left in there, even after this, even after millions of years of evolution. So when I heard that, I thought, wow, that is super interesting, because it got me thinking, how many systems out there that appear to work actually have traits inside there that are somewhat still subpar, even if the entire system has been able to work really well over a long period of time, right? And so that also got me thinking, like, perhaps there's still so much room, unimaginable room for improvement in like our daily lives, in the economy, in the business world, in so many things. Because we may see something that has worked for a long run and assume that, wow, this is great because it has been working for the long run, it has been working well. But underneath it, there may be a lot of different parts that are actually not well designed, and that can actually be improved and changed. And so our human body, I think, is a great example of that, right? Where even though we have been walking upright for, I don't know, hundreds of thousands or millions of years, our backbone is still not all the vertebrae in our backbone and our spine, they're still not perfectly evolved to be able to walk upright. Yeah, so I thought that was a kind of a really interesting thought, and it was also interesting for me because as I heard that piece of information from Thomas during lunch yesterday, I over the past few days I've actually just started reading this book called A Crack in Creation
Mm-hmm.
by Jennifer Doudna
Yeah.
and Samuel Stenberg. So it's a
Mm-hmm.
book about CRISPR technology, right? Which is technology you can use to actually edit a person or an organism's DNA, and the editing can be done on in a way where you can actually change the DNA of a person such that the changes can be inherited by this person's uh, progeny, right? And it can also be edited in a way where you can just make changes to the individual without him being able to pass on the changes of the genetic information in him to his offspring. But it's just fascinating because I'm just thinking, wow, like with like technology like CRISPR and all these discoveries or little known things about the human body, how much better can human health be? For example, like if we can actually use CRISPR to make what so earlier I mentioned this thing about genetic changes that can be inherited. So
Mm-hmm.
this is the proper term to use would be making changes to a person's germline DNA.
Mm.
Right. So I'm just thinking, is it possible to just use CRISPR, to change the humanity's germline DNA such that we have a better spine? And maybe that can
Mm.
make a big difference to our overall health and our overall well-being, right? Like the possibilities are, I think, breathtaking to think about.
Yeah. So I actually did a university presentation on evolution. Yeah. So it's more like I think that once you and this goes back to it touches a bit on the innovator's dilemma, because when a company becomes really good at something, and you can almost draw an analogy to football teams even, which is something which talked about with my friends, right? So in a football team you have 11 players, right? And when your team becomes a championship winning team, which is winning titles for multiple years, as a coach you wouldn't want to swap out any of the players, right? Because they are the best in their position. But what that causes is a problem of succession, because the lifespan of these players are probably somewhere between 5 years to 10 years. If you're lucky, 15 years. And at some point, you're going to have to swap these players. And without giving the new younger players the chance to actually play, you're going to damage the team in the future. So there's this very difficult balancing act, I think, to actually pass on uh, all the positive traits, because that transition is usually really hard. And I think very few managers, maybe only Alex Ferguson, who has done well to transition teams multiple times, because I stayed with Manchester United for so long. Most managers don't stay for very long. So the other thing which as you mentioned, that about companies which look really good on the outside but have many defects on the inside. I'm going to share some personal work experiences as well, without mentioning any names. but I've been in call it good companies and bad companies, right? And what I found in bad companies is that problems are usually ignored, right? You want to present success stories. You don't want to talk about the problems. You leave the problems there and hoping someone uh, discovers it, and whoever holds it will be the one who solves it, right? And that's really, really bad culture, because that problem is going to blow up one day, and then everyone's going to scramble. And when you look at the other side, where you have good companies, what surprised me the most is that because I was in a, call it a bad company, and I moved to a good company, and the contrast was so great, right? So when I got to this good company with much better culture, it's the HP culture, by the way, or the remnants of it. One of my, I think it's one of the most fascinating cultures which I've actually encountered and experienced for my own. And I saw so many good things there, and I was so happy and excited, because I come call it I'm moving from hell to heaven, right? So but what surprised me was that the people in the good companies are so dissatisfied with how the company is, right? They see all the problems and defects in the good company. They said that, oh, we're doing badly here, we're not good enough here. And that's maybe one of the most surprising things about moving from a bad company to a good company, because the good company, they're actually owning problems. They see problems. They're not satisfied with where they are, and they are very well aware of where their shortcomings is. And they are constantly comparing themselves against better and better players, and trying to become better and better all the time, which really wraps up this podcast, because we are about being better all the time. This is the Better Podcast. And we do hope that whatever we share today does help you get better, whether it's in your life, investing. We can't promise a better backbone at the moment, but hopefully this does help you become better in every sense.
Yeah, what a nice way to wrap this up. Thanks everyone for listening. We'll see you guys again soon.
Yeah, see you.